Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter like we normally do, see what people are sharing on social media. I'm sure we'll touch on NVIDIA once or twice. Um, it's going around social media quite a bit. I will say, I was at the grocery store today. No joke. I ran in early. There was another guy talking to one of the people who work at the store. He was stocking shelves. It was King Supers and he was talking about Nvidia, the stock, and how he told his buddy to buy this stock, and it's up, I don't know, however many dollars. As I walked by, I was like, wow, so that's what they're talking about. That's where the bubble is. It's definitely an Nvidia. Either way, it's going to be wealth building, financial topics, and or commodities is what I'll be talking about in this particular clip. I'll share my financial opinions as we go through it, and let's dive into it. You want to follow me at Finance Grow Finance, and if you want to join our community, finding-value.com, that is where I share my opinions on individual companies. I do trainings. If you guys are interested, I cover topics of your guys' choices, and I go over things of what I see in the market and the approach that I take and strategies. And some of the strategies we're going to see right here. So OIH, energy service companies look solid to go. PSCE is another ETF. Looks solid to me. It's a small cap energy ETF. The gold to oil ratio is very cheap at 1 ounce of gold to 26 barrels of oil. An expensive ratio is below 1 to 10. So we're still at a very cheap ratio. And with what the charts look like, they look pretty good. So I'll open this up. This is OIH looking like it's ready to break to the upside here, looking pretty strong. PSCE, which is the Invesco S&P Small Cap Energy ETF, that's breaking its downtrend line. And these also have larger, bigger pictures, inverted head and shoulders. This one's already broken the neckline. This is the neckline going across. And I think we could see a very big move in energy, which is also going to impact consumer price index and a bunch of other things, probably 6 to 12 months from now. And then we've got the gold to crude oil ratio here, and it's at 26. There it is. It's at 26 right now for a ratio, and that is very cheap. And we're going to see this actually compress lower, in my opinion, where crude oil will outperform gold. Coming on down, we've got Oxy. Buffett about to get paid. The squeeze is about to pop. He purchased here, 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 here. He does the same type of stuff that I do. We cost average in is what I do. I try to get the best prices possible. We've got the pattern that formed, and here we are breaking to the upside. You can use ratios to tell you where your valuations are roughly should be. If it's cheap and you get good patterns and things, the sentiment is bad, generally when you want to buy, and sentiment was really bad in the oil energy space, and I love that. I absolutely love it. And even so, energy service is even more cheap than the exploration production companies. But either sector, I like both very much. Here's nat gas, such a clean chart pattern. You can see it's been going down, 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 and we're up towards the upper end of that. So we'll see if we can break through in nat gas. That will also help, I think, money flow into energy. We've got XOP versus GDX. Looks like it could be breaking higher here. We've got XOP versus COPX, which is the copper ETF. GDX is the gold ETF. And XOP versus MU, which is the agribusiness ETF. And what I'm trying to gauge is I'm trying to gauge if energy is well positioned against all of the other asset classes. And I'm comparing against other commodities here. So here's XOP versus GDX. I gotta shrink this back in. There we go. Look at that squeeze in the breakout here. That looks pretty solid here for an outperformance of XOP versus GDX. Now, I'm not saying that XOP is the way to play it. I'm taking companies in XOP's sector, the energy sector, and I'm looking at potential investments when it was down in this corner here, when sentiment was really bad. And I would enter a cost average in. And now I think it looks like everything's about to break to the upside for the energy ETFs. This is XOP versus COPX. It looks like that's squeezing up against it as well. And it has a nice little pattern that we're squeezing right into the corner here from a cheap valuation. So XOP is cheap to COPX because it's so low. The average is above us about this area around 5-ish. Looks like we've gotten all the way down to 2 and all the way up to about almost 12. And I'd say the average is somewhere in the fives, roughly where I put that line. And then this is XOP versus MOO, the agribusiness ETF. You can see the big squeeze into the corner of 2020. November, October 2020 was the best entry point. Believe me, I took as much advantage of that as possible. Been riding it the entire time. You can see that XOP has been the preferred ride over MOO. We've got the SPY and QQQ. We've been going up, but as this relative strength start to decline and we see a divergence between movement upward and a potential weakening of the underlying strength in it. Will this roll over? I'm in the camp that it will eventually. I don't know how much longer it can go up. I don't know. But I don't think the risk reward is that great up here. So I avoid stuff like this because I don't want to get caught up in a big sell off. I go where the risk reward is really good, much like we were talking about earlier, that I do like energy. And I've got a lot of particular investments around energy. Bring it up during the, well, you guys already know if you're part of the website. You already know my favorites. We've been talking about that already. Coming down, the top 5 US companies by market cap are now Microsoft, Apple, Alphabet, Amazon, and Nvidia. Here's a chart comparing the top 5 stocks in the market throughout history. Currently, the top 5 stocks in the US reflect 25% of the S&P 500's market cap. To put this into perspective, in the dot-com bubble, the top 5 stocks reflected just 17% of the S&P 500's market cap. Just 4 years ago, the top 5 stocks reflected 18% of the S&P 500's market cap. Big names are getting bigger. This to me looks like a double bottom. You can see the lead-in pattern. There's a bottom here, and then the bottom of the bottom was 11 and 14. Then we're rocketing on up, and this still could go up a little bit. I mean, this is a pattern that generally might work up a little bit higher. And then we'll have some blow off top or something, and I'll cave back down. And maybe it takes another 6 months or longer to do that. Coming on back, we've got, man, it's been a hell of a month for Silicon Valley and NVIDIA going up today. It is the single biggest market cap gain day ever. It has now beat Meta, which was in 2024, which is almost about 200 billion, but we hit 277 billion in the single day market cap gain. Eric says, interesting, in the fourth quarter of 2023, the Bill and Melinda Gates Foundation Trust dumped its stake in several large companies, including Apple, Meta, Google owner Alphabet, Amazon, and Nvidia. This guy's been through a bubble or two, I think, and he knows what's coming up. So he's selling, and Jeff Bezos he's been on a tear selling his stock too. You got to, so in Jesse Livermore, he was given the opportunity to unload shares. And really what they needed to do is they needed to create retail buying frenzy so he could unload a lot of shares into the retail's hands. So they need to generate excitement. I do think that they are doing this on purpose somehow. If you notice, the move in the morning gapped up in the day, and it is interesting to see that these guys are just offloading a bunch of shares. They need the volume of retail to offload their shares into, and that's exactly what Bezos and Bill Gates and and Zuckerberg are doing. They've got the volume there to just unload their shares right into it. They're all in on this stuff, guys. It's my guess. Excellent chart by DB showing fund flows across categories. Notice where gold funds are currently. So this is the fund flows across categories. These are the ones getting the funds flow right now. It's all in the upper right, all equity, large cap blend, small cap blend, munis, all that stuff. The ones that have slowed down and are coming down are bank loans, small cap value, large cap values. Oh, small cap value. The ones that have below average and slowing, this is the area that we want to be buying outside of government bonds. I don't want that, but gold funds, long-term bonds, utilities, mid-cap value, mid-cap defensive equities, emerging blend, large cap growth, and here's energy. Energy's been coming down here in really bad sentiment and materials too. This is where I'd be looking. And then the ones that have just come out of it are technology is coming to the right here. Telecom, real estate, U.S. staples, healthcare, U.S. dividends, cons goods, tips, balanced funds. So these just rotate through, and this will probably come down. This will move to the left, and this will move upward and to the right. Moving upward means that you are below average but rising. So you're rising, but you're still below average. And then you come back over here when you're above average and rising, and you've got really good fund flows into it. Gergen says a mixed EIA report with a moderate crude build and product draws. Refinery throughput continues to stay suppressed. Year to date, commercial crude oil inventories are up 11.9 million barrels, while Big Four products are down 21 million barrels. So these are the different areas that are products, and it looks like I have to shrink this or ink it down. There we go. This is stocks of motor gasoline. It's kind of 5-year average. Oh, it's just below the 5-year average. Here's the 5-year average in the purple, right just above it. This is stocks of distillates. This is way down. Looks like towards the bottom of probably some of the tightest areas. Think of that as like diesel. Stocks of jet fuel, about the 5-year average. We're right on top of it or so for the 5-year average. And then stocks of propane, propylene, right on the 5-year average is where we're at currently. So if you were to add all these up, I would say that we are slightly below average. Coming down, Q4, oil inventories, 4,241 million. Kepler year to date, oil inventories down 87 million across the board here. Inventories down 1.66 million barrels per day. Inventory related Brent is $100 is what they had back then. So if you look at the Brent spot price and then you look at the OECD oil stocks, we were coming on up with all that inflation. And even though the price was up around, 100 and was that 120, I think it's where it got to. Look at where the stocks were, the OECD oil stocks and oil on water. The stocks are continuing to deplete, and the price, we're at like a little under $80 a barrel here. I mean, we are really, really low for how much inventory we have versus the price of Brent Sprott and West Texas Intermediate crude. I don't think this is a huge value in terms of buying oil with inventories this low. Yes, it will take time. Inventories will continue to draw. We're going to be coming into seasonal strength for demand, and that's where I see the opportunity. Newmont's bottoms in, been expecting what we saw today. That's what Deborah Robinson has said. So I wanted to bring up Newmont. So here's Newmont. I brought Newmont up. And to me, I don't think this looks very good. I mean, this is a big selling pressure day. You usually get a big bearish engulfing at the top. It sells off, not much buying pressure all the way down. Get a little bit of buying pressure through here. We've come up and squeezed into a corner, but broke to the downside there. Some people would say, it's a false breakout. I don't like seeing a breakout with that strong of a move. We've come on up, but guys, this is a bearish engulfing. That still looks like it's got some serious thinking about which direction this thing wants to go in. A lot of selling pressure coming in today, and that's what it looks like, just massive selling pressure, and it still looks like we've got more downside. That's what I see. So would I call this a bottom? I would not. I don't think this is a good location, but that's her opinion. I'm not going to bother updating the comparative inventory plot this week. Essentially, no change in calculated WTI fair price, which is $80. So based off of the inventory levels of commercial inventories only, we are at almost a fair value of $80. Now, I listened to a clip, I only listened to a small little clip of it, some oil expert, and he's like, Saudi Arabia is holding this market up because of their spare capacity. Guys, the inventory levels across the board in terms of strategic petroleum reserves and in terms of commercial inventory levels are not very high. They threw everything at this to hold the price down. What Saudi Arabia is doing is counteracting what they are doing, what they did. So they cut back on production. There's probably 1 million to 2 million barrels of spare capacity that they've got, is my guess. And we're at basically fair value for inventory, and we've got a lot of demand coming. Where I get scared is what's going to happen when demand exceeds the full pumping capacity of the world, and how long will that last for, and what price are we going to see, and what if we get a a decline in the shale oil? It's going to be a real interesting setup. So I am positioning for that outcome. I am positioning for the world to basically get super tight in about a year from now. You know, mid to late 2025, I think the world's going to be really tight on oil. I think we're going to be tight on diesel. I think we're going to be exceptionally tight in that area. We've got a lot of LNG capacity coming online. I think energy is the spot to be, in my opinion. But I've got a lot of ways to play all this. Stocks could get hit hard if a second wave of inflation takes hold, warns J.P. Morgan strategist Marko Kolanovic, who believes 1970s style stagflation could hit the U.S. economy. So there's still people out there that think that there's a second wave of inflation coming, and that it could have an impact on the way that assets are being priced. So we've got oil that's super cheap, and this is the most inflation sensitive asset with declining inventory. We've got these guys selling out of their tech stocks, which are putting in rising wedges, and they're right at the peak. And then you've got Marco saying, look, guys, we've got a second inflationary wave potentially coming, and it could weigh on the stock market. That is it. That's everything tied together here. That's all the data that I see in the market is basically what this guy's stance is. Bullish trend, the EIA, we had crude build at 3.5 million barrels, but we had product draws on gasoline and distillates a little bit greater. So we were essentially flat this week. This is from Range Resources fourth quarter presentation. Net gas demand to grow 23 billion cubic feet per day by 2028. Call on U.S. gassy basins to rise 16 billion cubic feet per day. That is huge by 2028. Here's 2023 demand, and look at the move in demand between 2023 and 2028. That demand is coming from residential, commercial, industrial, and other electric power demand, Mexico exports, and LNG exports. And the bulk of it's coming from LNG exports and industrial and other uses. So we've got huge natural gas demand coming over the next few years. Kim Benny, this is a different look. This is a bit slower now, but still drawing inventory counter seasonally. Let's not forget that both the driving season and proper compliance of Russian oil export to OPEC plus cuts are just ahead of us. And we continue to draw down at a slower pace, but we are drawing down on oil inventories. He says, I totally disagree with Turd on Newmont. The problem isn't Newmont. The gold miners are competing with central banks like the Fed that can print trillions of treasuries at no cost. The market psychology continues to funnel funds into financial assets. Unfortunately, The world only has enough energy to produce the GDP, goods, and services, and not much left over to settle the 281 trillion of the new financial assets since the 2008 great financial crisis. How can precious metals analysts complain about the companies that will provide the future gold and silver supply we will desperately need? The market psychology will flip back into real assets as the world heads over the energy cliff and as central banks really ramp up the printing presses. I agree. And the disconnect between energy and the printing presses is where I think the opportunity is. The most sensitive inflation asset is oil. And then I think that physical metals will also get a big boost when people figure this out. And we could still be a year or two away from that. But a big disconnect there. This is financial assets in the red. And then oil consumption is in the yellow, global GDP is in the blue, just to let you guys know. Coming down, whoop, we got to go back first. Home builders still moving to the upside. XHB ETF just ripping it. There we are, ripping to the upside there. Massive move to the upside there, and as expected, we're in a home building expansionary phase of real estate. We've got silver here, so historical inflection point. Watching gold as a huge blue breakout, plus holding 2,000. So silver's just sitting below its massive 13-year blue breakout line, and silver already has the false breakout done. So the counter move to gather energy is already done. We're just waiting for the break on silver. What's going to cause the breakout? I don't know. Broken out, and we're just sitting on top of the pattern, ready to rip. Ready to rip. And that's what I've got for today, guys. So thumb up for the content, subscribe to the channel, subscribe to the website if you like. 5 p.m. question and answer session coming up on Sunday. I'll see you guys there, and we'll catch you next time. This is Finding Value.